The party's been wild. Moonshots, meme coins, 100x dreams. But every party ends the same way. The lights flip on, and the cops show up. For crypto, the cops wear suits, work in government buildings, and they're coming with regulations that could rewrite the rules overnight. For years, crypto's been the Wild West, a frontier where a teenager in a basement could launch a coin and raise millions before lunch. No gatekeepers, no borders, no bankers wagging their fingers. That freedom? It's exactly what made crypto explode. It's also exactly what's making governments sweat bullets. And now, they're circling. It's not a question of if regulation comes. It's when and how bad. The US, EU, and even crypto-friendly Singapore are drafting frameworks to rein in decentralized finance, exchanges, and even stablecoins. They'll tell you it's to protect consumers from scams and systemic risks. And sure, we've seen enough rug pulls to make that argument stick. But regulation has another side: control. Once the rules are written, the freedom that built crypto starts shrinking. Take the US SEC. They've been on a legal rampage. Lawsuits against exchanges, labeling random altcoins as unregistered securities, and pushing for KYC, know your customer requirements everywhere. If you think your favorite privacy coin is safe from their radar, remember, regulators hate anything they can't monitor. And governments don't just dislike losing tax revenue, they see it as a personal insult. But here's the paradox. Regulation could kill some projects while making others stronger. Think about it. When the internet got regulated, sketchy websites vanished, but Amazon, Google, and Facebook thrived under clear rules. Crypto could see the same split. Fly-by-night meme coins disappear, but regulated, compliant exchanges and blockchain platforms grow into giants. The winners? Likely those with big legal teams, transparent operations, and, yes, the money to lobby politicians. So what does this mean for you as an investor? First, expect volatility. When a new rule drops, like a ban on staking for retail investors, prices swing hard. Traders panic sell, whales buy the dip, and the market whiplashes in hours. Second, watch liquidity. If an exchange gets slapped with a fine or trading restriction, suddenly your assets can't move. Owning crypto on an exchange isn't the same as holding it in your own wallet, and regulators know it. Third, follow jurisdictional shifts. Some countries will tighten rules until it's unprofitable to operate there. Others will position themselves as crypto havens. Think Dubai or certain Caribbean nations. Projects will migrate. Your favorite token's headquarters might mysteriously relocate to avoid trouble. Here's where it gets personal. If you're holding a portfolio full of speculative, regulation-unfriendly coins, you might be holding future roadkill. Coins built for anonymity? At risk. Unregistered token offerings? At risk. DeFi platforms that skip KYC entirely? Huge risk. But projects with real-world use cases, like blockchain payment processors, supply chain tracking, or tokenized real estate, might benefit from the added legitimacy regulation brings. There's also the stablecoin question. Regulators are obsessed with them because they bridge crypto and traditional finance. When you've got billions moving in tokenized dollars, euros, or yen, governments start imagining scenarios where people bypass their entire banking system. That's their nightmare fuel. Expect strict audits, collateral requirements, and limits on who can even issue stablecoins. For you, that means fewer too-good-to-be-true interest rates on stablecoin savings accounts, and more boring bank-like offerings. And don't forget taxes. Regulation means every transaction, even swapping one crypto for another, could be a taxable event with paper trails attached. That privacy you loved? Gone, unless you're willing to risk fines or worse. The days of "nobody knows what I'm trading" are ending. So how do you survive, maybe even thrive, in a regulated crypto world? 1. Diversify. Don't bet everything on one type of asset. Mix regulation-friendly blue chips like Bitcoin and Ethereum with high upside but higher risk plays. 2. Self-custody. If you don't hold your keys, you don't hold your crypto. Regulation could freeze exchange accounts, but your cold wallet doesn't ask permission. 3. Watch policy like you watch price charts. A new bill passing in Washington or Brussels can move markets faster than a whale trade. 4. Focus on projects building for compliance now. If they're already meeting future rules, they're less likely to implode when those rules hit. The truth is, regulation is both a threat and an opportunity. It will create winners, losers, and a lot of noise in between. The key is knowing which side your investments will land on. The crypto Wild West isn't ending. It's just getting sheriffs. And sheriffs have rules, guns, and the power to shut down the saloon. The storm's coming. You can either stand in the rain or move where the sun's still shining.